Why, hello and welcome to the Lending Podcast. This is going to be an exciting episode with my guru, JB, and my name is Jeff Jones. We're here from Benchmark Mortgage in Austin, Texas. You are tuning in to the Lending Podcast. You can see the grins on our faces. This is going to be one of the most exciting episodes we've ever done. What are we talking about, JB?
Well, we're going to solve the affordability crisis right here, right now, today. The housing affordability crisis is solved at this table right now.
So for 2.5 years, no one has solved the housing affordability crisis. We're going to do it in one episode.
It's super easy. 30 minutes.
30 minutes, you will know how to fix the housing affordability crisis. I'm excited. So in the news, it's a hot button topic. It was even a debate question between our political rivals going on right now. And,
Yes,
I really want to make sure people out there, if you've listened to us before, we give a lender's perspective. We are loan officers, loan specialists, been in the industry a long time, at least you have. I'm newer into it, but you've been a couple decades in now.
Yeah, we're 30 combined years. 24 and 6.
Yeah.
So, yeah.
Man, that's quick math. I like it.
Yeah. Well, that's what I do. That's what I do.
So, when you're listening to a lender talk about affordability of a loan, it's going to be a very different conversation than the news media, than the political conversations out there. We're going to give you brass tacks of what will make basically the affordable environment again for our people out there. And it is doable. It's possible. We've been there before. How do we get back to it?
Yeah, and I think what we're seeing, the conversations we're having about monthly payment, about affordability, it's really this all-encompassing topic of everything else also being more expensive, right? Your health insurance, your car insurance, your cell phone bills, of course, grocery bills, whatever. And so as we talk to prospective home buyers who are looking at their monthly payment, maybe comparing to what they're paying in rent right now, and saying, I want to buy a home. What's it going to cost me? And sometimes in many cases, there's some sticker shock and sort of a gap, I would say, between where a client wants their payment to be, where a homeowner wants their payment to be, and where their perception of sales price is for that payment. And again, that's the affordability gap, if you will. I want my payment to be $2,500 a month, but I'm looking at this house, it's $400,000, and where's the balance there? Because typically that's probably not a $2,500 mortgage payment right now. It would have been 4 years ago, perhaps, when we run the numbers. So we're going to dive into really what makes up the majority of the sales right now in our industry, like in our market. What is selling? And this concept of there's a housing shortage, right? There's a housing shortage we've heard 4 million homes. We need to build more homes. That's true. We do. But what kind of homes do we need to build?
I like that. I think that's a good topic. I want to make sure people get convinced that, in my opinion, rates are the answer.
They are.
I think if you don't hear anything today on the podcast, I want to kind of solidify that we're having the wrong conversation as a nation about how to make houses affordable. It's the wrong conversation. I really believe that. I think the right conversation is how to get rates to an affordable environment. And people say, 6% rates just fine. Not when you're a first-time home buyer with the price points we have.
Right.
And to be honest, the price points are not crazy. So year over year, the average house has gone up 3%. 3% is a normal year over year growth rate for a house price.
Appreciation rate, yeah.
So that is not the issue, is the price point of the house. The issue is your monthly payment. And the monthly payment is going to be your affordability issue.
Yep.
So to get a lower monthly payment, we don't have, people are like, oh, you could just buy down the rate. When you go from a 7% rate trying to get to a 3% rate, you can't buy that down enough.
It
costs too much money.
Yeah, it costs too much money. The break-even analysis, if you will, the amount of cash it would take to buy that down is way more than even the down payment would be in many cases.
So we call those point buy downs, and a 4 points as being 4% buy down is ridiculous.
Yep.
Now there are plenty of programs out there that you see market advertised as temporary buy downs. Mm-hmm. And there's a 2-1 buy down, a 3-2-1 buy down, a 1-0 buy down. What that means is temporarily for those years, whether it's 1, 2, or 3 years, you get a lower rate. Well, you're paying for that up front, so it's just basically a prepayment held in an escrow account. But that doesn't solve the long-term affordability.
It
And
really
you're still
doesn't.
not qualified. You're qualified on your long-term rate.
Yeah. So let's solve it.
Let's solve it,
Let's
JB.
solve it.
I
Okay.
like it.
So there's a lot of statistics out there right now. One of the stats that really jumped out at me is over 50%, 52%, I believe it was, of existing homeowners would sell to do a move up if they could get a rate in the fives.
Yeah.
And the issue, of course, is they're a current homeowner. They feel stuck in their interest rate of maybe 2.5 to 3.5%. Somewhere in 2020 or 21, they either bought or they refinanced or both. And they got a rate, let's just say it's 3%, right? On average, a lot of those rates are at 3. Well, to sell and buy seems daunting when you're jumping or you're doubling your interest rate on the purchase. So you're buying a higher price home and you're going to be financing more perhaps, and now the interest rate's higher. So it compounds that payment issue. Now, why is that important? Well, it's important because we need those homeowners now to list and sell their homes. So our buyers that are entering the market are buying an established home in a proven neighborhood with a great school district. And yes, there's something very, very desirable also about new home builds and new home neighborhoods. Those aren't necessarily for everybody, though. There's a lot of folks that want a pre-owned home because of the location. And so I think building more homes is a solution, yes, but it's not the solution. I think it's a combination probably of both.
Yeah.
But it's so critical that we get our interest rates to a point where we are enticing current homeowners to sell houses that have been well taken care of, lived in, right? And that's desirable. Mature trees, a backyard, whatever, all the neighborhood amenities, again, close to restaurants and schools and shopping, et cetera. And so we're not seeing those sellers put their homes up. That's part of the issue is the entry level buyer. So we ran some numbers. Over 60% of the sales right now are homes under 400,000, right?
It's about 50 something percent.
Over 50%.
Under 500, it's over 60.
Okay.
Under 400, it's probably close to like 55. So most of the bulk of that volume is 300 to 400. So yeah, you're right on. So
and that doesn't break down the stats we pulled. It doesn't break down necessarily new home construction versus resales.
Right.
But the bottom line is the homes that are moving are under 400 grand.
Right.
Over half the homes that are sold. So where's the inventory opportunity? Well, the inventory opportunity is a 600, 700 plus, 750, a million plus home that $400,000 or $500,000 homeowner has right now with equity, selling that home, putting that equity towards the purchase. Their family's growing. They want to move school districts, whatever the situation is. And that will relieve and provide some inventory, some established inventory for those buyers that are coming into the market. How do we fix it? We get interest rates down. Let's talk about getting interest rates down because we know the secret.
Before we do, so the housing shortage, I like this. I just want to camp on this for a little bit.
Yep.
It's a little personal story. My wife, God bless her heart, 22 years of marriage, is going strong. She loves looking at those websites that have housing, Zillow.
Oh, she's looking every day, right?
Pretty much. We have kids. We have 2 kids, and they keep growing. Imagine that. You give them food and water, and they keep growing. But that means as they're going into middle school, as they're going into high school, we're looking at extra space in our house. We really don't have it. She started a jewelry business, so she's like taking over part of the living room, part of our bedroom. I have my office in our house. But like we just want more space.
Sure.
Like a lot of people out there. But we feel stuck, right? That move up buyer that wants to say, I want to sell my current home because we have equity in it. Like we have hundreds of thousands of dollars of equity in it. And then we want to buy that next house. We want an extra room. Maybe we want a second story instead of a one story so that the sound of the kids is on a different level than, where we're making dinner. So the basic move up buyer has felt stuck for almost 2.5, 3 years.
That's right.
A lot of us out there. And what's interesting, JB, is like I'm getting housing reports of neighborhoods that we look at are desirable. Those $850,000 houses are now $750.
Ooh,
Those $750,000 houses are now like $699, $650.
interesting.
Affordability of price points has gotten more realistic.
Right.
So those neighborhoods are now right pricing,
Mm-hmm.
and so it's not a price point issue. And honestly, it doesn't feel like an availability issue because there's some really good houses on the
There
market.
are. Yep.
On my street, there's a bunch of houses on the market. It's the fact of trading in that monthly payment.
Yeah.
No one wants to trade in, a $2,200 payment for a $4,500 payment. It That's a tough pill to swallow, or even a $5,500 payment
Except for one of your
$6,500.
clients right now.
Yes, but again, that life choice is
Right.
we
There's
want
a
to get
life
to the
choice
right
there.
school district.
Yes.
So
Well,
it might not be a move up buyer, but it's a move over to the better school district.
true. And we've touched on this a
Right.
little bit too. You've got what I would encourage every homeowner out there today to do if you have the aspirations of moving is run the numbers.
Right.
Run the numbers, because if you can get 300,000, 200,000 out of your sale, and you're going to put 20% down on a purchase, 750 purchase.
Right.
So you're financing 600,000, 150 down in cash. What are you doing with that other 100 to 150,000 in proceeds? Do you have debt you can pay off? Do you have some credit cards? Do you have some
Right.
student loans? Do you have higher interest debt ideally? And then what is that actual payment differential? Because you might go from a $2,500 payment to a $4,500 payment. Yes, your monthlies just increased $2,000, but did they, if you wipe out $2,000 a month of other stuff,
Yeah.
and then turn your bigger home purchase into a larger tax deduction, which we've talked about before,
Right.
which could actually bring down the amount of IRS taxes that you
Yeah.
pay on an annual basis, could actually save you money. And you're getting appreciation now on a 750 house at 3%, which is 20 grand a year, versus appreciation on your $400,000 house, which is 12 grand a year. So you're building wealth exponentially with that upgrade. However, having said that, it's just not necessarily the time for everybody. But I do challenge you out there to actually run the math with a mortgage professional, with your CPA, with your financial advisor, because I would argue that more often than not, it actually might make sense.
My wife would love to hear that.
Yeah,
So
she would.
I like that. I want to.
Does she listen to this or watch this? Maybe we won't share this episode.
I
with
can't
her.
answer that question.
We won't share this episode.
She hears me listen to it.
Fair enough.
There we go. So that's kind of strange that I listen to my own podcast.
That's
but,
kind of weird.
I figured it'd be good.
Gotta remember what we said. We gotta remember what we said, so we have a new topic for next time. We don't want to repeat every time.
And for those of you listening, we're gonna take a little moment here to talk about episode 39, shifting market in an election year, because if you haven't heard it, go for it, listen to it. But I want to take a second step from that episode. The concepts we talked about in there is what the Democrat agenda is to help bring down affordability, and what the Republican plan is. And honestly, both of them are wrong. What we think, because they're not addressing the rate problem.
We agree. Yeah, we agree on this.
They're not addressing the rate problem.
Yeah,
and that is the affordability problem. I truly believe that. So even though we said it earlier, I'm going to say it again. So we talked about that in episode 39, but we're going to take it a step further right now, because if you just throw money at a down payment assistance program, by the way, we have down payment assistance programs. They're great. They work.
Yeah,
so,
you can already get $25,000 in down payment assistance today. That exists. A
so that does
$500,000
exist.
house.
We're here in Texas. We do them all the
5%
time.
assistance. Yep.
Like we just do them all the time.
Yep.
And so that's not a problem. Also, if you have a couple $100,000 of equity in your home, down payment assistance isn't your problem. So just throwing money at home buyers is not what's keeping them out of a home. It
Agreed.
really isn't. I truly believe just throwing more housing options, we just need more houses, is not the problem. It's affordability of those houses.
Well, and true, and building more houses is absolutely part of the solution. However, it's going to take years. That could take 2, 3, 4 years. If we're talking about building 3, 4 million homes, how long does it take to build 3 million homes? Right? I don't know that we can really sustain in this market with these kind of stats and lock our existing homeowners and prevent them from moving. It's going to take too long to build the inventory necessary. So
now timing is good. The timing is
today.
good. So quick question. How quick did we go from 3-4% rates to 6-7% rates in a month?
It was
monthly
fast.
span?
It was like 90 days.
It
Yeah.
was 90 days, give or take a few days.
Mm-hmm.
Anybody that has any kind of charts online can look at that. We can source some
Let's call it
information.
6 months. It went
Just go
from
to Fannie Mae's website. They'll
three
tell
and a
you.
half to 7 in about 6 months, roughly. Yeah.
Yeah, that was the 6 month span.
Yeah.
So let's say, what does it take to go from 7 back down to 4?
Hmm.
How many months can we do that, guys? Are
That can
you
happen
out
in
listening in America?
that can happen in a couple months.
That can happen in about 2 months.
Yeah.
If we do these steps that we'll tell you to do.
Mm-hmm.
Who's ever listening out there that has the powers that be.
That's right.
So it can go in reverse as quick as it came up. It probably won't. I know we're pie in the sky thinking.
It's a little bit of a pipe dream today. Let's have a pipe dream.
But we're going to have the pipe dream and solve the housing affordability crisis. So we're going to go through why we think rates is the solution and how to get rates back down.
Yeah.
So for those of you that are listening, if you want to know what makes up an interest rate, how we get the interest rate, that's episode 17, Interest Rates Explained. So please check that one out because that goes into how the mortgage-backed securities influence things and what basically banks do with the secondary market and how those are priced. So that's good. So let's talk about how do you want to bring rates down, JB?
Well, that episode 17 is all about mortgage-backed securities. That's all about how mortgage bonds trade behind the scenes, right? So thousands of loans are closed a day. Those loans are packaged. Those loans are sold. We go into detail in that episode. So the acronym MBS stands for mortgage-backed securities. And so when mortgage-backed securities are traded, that is what causes bond yields to go up and down. Bond prices go up and down. Prices and yields are inversely related. So what we're going to talk about is stats today from 2019 to 2024, specifically on the mortgage-backed securities bond trading market. Okay, now stay with us here because this is how we're going to solve the affordability crisis.
So again, let's just clear up a few misnomers. When we're talking about bringing rates down, it's the cost of the rate. So a 4%, a rate that starts with a 4 in front of it, is available for you today.
Yes, it is.
It's just going to cost you an insane amount of money to get there.
Mm-hmm.
So it is on our pricing sheet. So when we look at your loan, if we're pricing your loan, it might say 4.75 on there as an option, and we can get that for you. But you're going to be paying a ridiculous amount of tens of thousands of dollars. It doesn't make up for itself over the life of the loan unless you get to year 20 on that same rate.
Right.
So it doesn't make sense, like the payback. So how do we get the cost of the rates? And there's really kind of a twofold piece I want us to talk about. The first one, loan level pricing adjustments. Loan level pricing adjustments are basically a cost that is on top of the normal cost of a rate.
Yep.
Normal cost being what the market is telling you it costs. On top of it, we have loan level pricing adjustments. And man, those have been really high. So to curb a recession and cool spending, it's not technically the Fed, it's a board. It's like the FEMCO.
Right. It's the Federal Housing Mortgage Loan.
We have paper.
FH.
It's a weird acronym
or something. Yes.
Yeah. So, but it's a board. That board is actually set by the president. He appoints the board, and then it has some banks as well. So it's a mix. It's a mix of federal. Like Powell is a part of this committee, right?
Mm-hmm.
And Powell was appointed by the president.
Federal Home Loan Mortgage Corporation, something like FHLMC or something like that.
We're fumbling on the name here, but
Fannie Mae, Freddie Mac. It's basically Fannie Mae and Freddie Mac together.
It's Fannie Mae, Freddie Mac. So what we're saying is banks and the federal government get together to say, how do we cool? What should these loan level pricing adjustments been? They haven't really changed much in the last 2 years. So we had an adjustment in April of 23, and it basically made a slight betterment for people with a lower credit score. But it kept loan level price adjustments higher than I have ever seen in my career over the last 6 years. So the loan level pricing adjustments are insanely high. So it's higher cost. So example of those would be like if an investor if you want to buy a second home.
Second home investor. I'll give you a real life example that is really, in our opinion, we've talked about this offline, hurting our current homeowners out there. And that is home equity loan level price adjustments. Okay, so I'll give you for instance, a homeowner who has 50% equity, right? They own a $400,000 house. They owe 200 grand. They want to take a home equity loan. For them to borrow 70%, let's just say 70% of their value, that rate and cost is higher for them right now than a buyer who's buying a new home putting 3% down.
Oh my gosh.
Now, why is an interest rate and closing costs higher for someone that has 30% equity, who's paid their loan on time, who's
Almost no
maintained their
risk.
credit, very little risk,
Yeah.
manage their debt well. All they want to do is cash out so they can send their kid to college or pay off higher interest debt or what have you. Do whatever they want, reinvest in a new property. And they're borrowing money at a higher rate and a higher cost than someone who's putting 3% down. Again, we believe in fostering activity for those buyers putting 3% down. That's a great thing. We shouldn't be punishing the homeowner who has 30% equity or 40% equity.
Right.
So it's really, that part's bizarre. And that goes back to Fannie Mae and Freddie Mac being in government receivership for 15 years and being GSEs, government subsidized entities. That's what we're talking about here.
It feels like loan level, it
government
feels like
oversight.
loan level pricing adjustments have gone way beyond what risk is about.
Yep.
It's gone to let's cool spending.
And that was we believe that was a money grab.
It was
2.5 years ago.
It's gone on way too long.
Mm-hmm, it has.
So
sure.
None of us were happy with it when they came out with egregious numbers 2 years ago.
Mm-hmm.
But they have stuck around, and no one's talking about loan level price adjustments changing. There's no wind of them changing. So hopefully those get taken back to how they were 3-4 years ago.
Yeah, and that
where they were
level,
actually tied to risk, not to cooling spending.
Exactly. And that loan level price adjustment specifically is hitting the homeowner, hitting the home buyer with a specific cost.
Yeah.
Which that cost, of course, is either cash out of your pocket, or you could absorb that cost by taking a higher interest rate. Either way, it's a gut punch.
Tough pill to swallow.
Yeah.
Some of the price adjustments are up to 4% on top of what their normal cost is on that rate.
4% of the loan amount. So 4% of 300,000, 12 grand in an extra line item closing
So
cost.
if you're an investor, if you want to buy a second home and you're only doing 10 to 20% down, you're getting hit with like 3.875 to like 4.2 points, depending on your scenarios.
And cost.
And cost on top of the normal cost of that rate. And so that's just ungodly.
Mm-hmm.
So there's a reason why people have moved away from what we call qualified mortgages. Rates that have these loan level pricing adjustments, they're going to really secondary financing options that are non-qualified mortgages, non-conforming options that don't have those price adjustments, because those are too heavy-handed.
That's right.
For, like you said, the home equity line of credits, the investor buyers, the second homes. It's just too much.
Well, and let's rewind just a half
step. So that
step.
affordability would be great to take back.
That's a huge step towards improving affordability, because that loan level price of what you just described,
and that's a scratch of the pen, by the way. To make that change, could be instantaneous.
That can equal. We're talking about a half to a full point in interest rate.
Right.
Is what we're talking about. A lot of cost here. Removing that cost lowers the cost of the loan, which lowers the rate
and affordability to buy it down even further.
But taking a half a step back, like, where did these loan level price adjustments really, what was the spirit kind of behind this change in 2022?
Mm-hmm.
Well, it was the market was screaming hot from 2020 and 21.
Right.
A lot of second home buyers, a lot of investor buyers. Money was a lot cheaper than it was now. Yes, of course, a lot of owner-occupied buyers as well. When Fannie Mae and Freddie Mac changed those loan level price adjustments, it was mainly to deter second home and investor buyers.
That was the idea,
and encourage more owner-occupied buyers, which we're a fan. I'm a fan of. I mean,
I am, except for the person whose lifeblood is, I'm a small-time property investor.
Sure.
I have 7 to 10 properties in my portfolio. I'm trying to get that 8th property, and now all of a sudden I can't buy. This is what I do for a living, is I buy properties and I rent them out. That's my job. I'm not a big company that's doing it.
The individual investor,
got
not BlackRock or
pretty
whoever
much got
these
stopped.
big companies that are buying. Yeah.
And then they had to go to unconventional or hard money loans, which are awkward and a much higher cost. But anyway, I digress.
Yeah, and there's now some other really good options for investors that have emerged, and We could talk about that on, I think we
Right.
have an episode on DSCR. I don't know what episode that was, but so we could talk about that more. But let's solve the affordability crisis.
Okay.
So that's one piece
Loan
of the
level
puzzle.
price, and that could be fixed within a day.
That is a stroke of a pen. That was a good way to say it.
Yeah.
That is something that absolutely it was put in place at the stroke of a pen 2 years ago
Yes.
by the head of the country.
I think we got like a really small heads up on it too. Like I think
like a
week or two.
Sure. Yeah.
By the way,
Yeah.
these costs are being incurred now.
Mhm.
What?
Yeah, I feel like it was March of 22, somewhere in there.
That
February,
April 1st
March.
It was going in.
Yeah, April 1st. Yeah,
Yep.
it was going in.
That was it. Okay.
It was pretty nasty.
All right.
Okay.
So the second one is actually bigger
It's bigger.
than the first, than low. So loan level price adjustments, you and I just fixed that today.
Yeah.
Wonderful. We stroked our pen. Those are gone.
I'll make a
You're
call.
welcome, America. Merry
Mhm.
Christmas. The second one, we can get done by Christmas.
Yeah.
If you and I were in charge of everything.
That's true.
So let's get in charge of everything. So a little perspective, I want to bring us back to the last 5 years, because a 5-year span is kind of the sweet spot of looking at amazing affordability to now, right?
Yep.
So 2019, 2020, and 20 going into 21, we were running red hot with affordability for homes. So we had a good run.
We did.
And for the last 2 years, 23, 24, and of 22, if you look at a rate chart, you will notice that 6.5% to 7% mark of an average interest rates on a 30-year mortgage has basically been the same. What I mean by the same, up or down a point.
It's been a very tight range.
If you look back, October of 22, we're now in October of 24.
Yep.
We're almost at the exact same spot.
Yep.
Like almost identical, guys, of
Yeah.
where
In fact,
we're at cost for rates.
We looked it up. It was 7.08.
Yeah.
For 24 months ago, October of 22.
Yeah.
7.08 was the average 30-year fixed. This morning we looked, it was 6.91
Yeah.
on Mortgage News Daily.
So what that meant is, guys, if you're looking at a graph chart and it goes up and down and up and down, we've been pretty much steady. The reason that happens in a market is when basically the buy volume and the sell volume equalize and balance each other.
Of the mortgage-backed securities.
So if you look at any other stock ticker, we're
Mhm.
looking at mortgage-backed securities market.
Mhm.
If you look at an S&P 500, if you look at an individual stock of a company, if the buy volume and the sell volume equal, then the average median price over that time span is the same, right?
Very simple. Yep. Very close.
That's what's going on with the mortgage-backed securities market. Is for 2 years we've had the same volume of buying and the same volume of selling.
Yep. Specifically, 800, 900,
900 billion in buying, 900 billion in selling in 23, 800 billion buying in 24, 800 billion in selling in 23.
And of course, we're not all the way through 24
so it's
yet.
probably going to be almost
sort of
exact same.
It'll
probably
on
be
pace.
900
Mhm.
because it's pretty low right now. Now, when you look back on a different year, let's just take, 2021. Instead of 900 of buying, it was 2,100. Now that's billions. So that's 2.1 trillion.
2.1 trillion.
2.1 trillion of buying and the same volume of selling that we have today.
That's right.
So when you have the same amount of selling that we have in the last 2 years, it's because it's 900.
Mm-hmm.
In 21, we had that same selling of 900. 2019, we had that same selling of 900. The difference was we had so much more buying. So we had more than twice the amount of buying as we did selling.
That's right.
Now, when you do that to a market, what happens, JB?
Well, that drove bond prices up, that drove yields down,
Right.
and that's what we want. We want bond prices to soar. Bond prices soar when there's demand, just like a stock. Look at Tesla in just the last few days, right? It's
So
up
when
20%.
people are buy, and holding, they're not selling, right? So they're doing buy, the value of that goes up. So the cost goes up, and that is inverse.
That drives yields down.
That drives yields.
So,
yields means the rate you pay.
So there's two words for that. That's essentially quantitative easing. Okay, quantitative easing is what the federal government was doing during COVID. Of course, we've said the word unprecedented a million times. We've never been through that before. And so coming out of COVID, we've obviously had accelerated inflation. We've had surge in prices, right? That's now leveled off.
Hmm.
And now we've hit this 2-year mark where, like you said, yeah, rates have gone up, gone down. You're watching the headlines, hey, rates went down a half a point or they went up a half. But overall, year over year for 2 years,
Hmm.
we're within point 0.1 of where we were, 24 months ago. So this quantitative easing, and we're not saying we need to get back to 2020 or 21 bond buying levels. That would drive rates way lower than
But
I
it'd be
believe
so
where they
fun.
should be. It would be
Wouldn't
fun.
it be fun?
It would be fun.
So what we're saying is, if we can get buying to more than selling, that's going to make housing more available.
Yep.
Available. Oh my gosh, I'm tongue twisting here.
Available.
Available.
Yep.
So the bond market, the MBS market, has basically been stagnant for
Yeah.
2 years. What you're talking about is, how do we get more buying, and who is buying?
And who's okay? Let's dive into who's buying. Okay, so in 2020 and 2021, there was about 2 trillion in mortgage-backed securities that were bought on an annual basis. The federal government bought more than half of those,
Yes.
roughly about a trillion, 1.4 trillion in 2020, 1.1 trillion in
Mhm.
2021. Okay,
So
but
the
this
biggest
year,
buyer
the biggest
of the
buyer
mortgage-backed securities was America,
was our federal government.
federal government specifically.
Yes. Now, we're only on the pace to this year, 2024, the Fed is on pace to buy 100 billion in mortgage-backed securities, which is less than 1/10 of what they bought 4 years ago. So again, stroke of the pen. I get it. There's a lot of things that need to happen. We're not saying to get the volume back where it was, but some additional level of purchases by the federal government, by the Fed, buying mortgage-backed securities, another 10 or 20% of mortgage-backed securities being purchased would drive yields down and find that balance where home owners now can feel comfortable selling and buying with a new rate of say 5.5%. I talk to homeowners all the time. Sure, if I could get 5% on my new mortgage, I would move. Or 5.5%, I would. And again, those rates are out there now, but they're so expensive. They are cost prohibitive for most sellers, most homeowners.
Yeah, and to me, this makes financial sense for the government to step back in. Stop being shy.
That's right. The water's warm.
The water's warm, and you're not throwing money at something that you don't get a return on. You're actually buying a bond that pays you back. This is a funny thing to me.
Yeah.
Is it's not going to increase debt in America. It's not going to increase taxes in America for the federal government to put money into the mortgage-backed securities, because they're going to it's a bond that they get paid back when it runs off.
Well, and I think that's maybe where the issue is and why the government's not buying bonds, because we are spending money on other things.
Yeah.
And so it does take some fiscal responsibility to take a half a step back.
Yeah, because you put it in, you wait to get paid back.
And say where are we spending money?
Mhm.
Where's our government spending money right now? And could we
Right.
divert 20, 30, 40 billion a month to mortgage-backed securities? And I think I would argue yes. Look at the numbers that we spend on other stuff.
Right.
There's definitely money there to be diverted to this, which is buying an asset, and that's going to drive yields down and really get this market off a high center, right? Yeah. Like it is right now. So yes, we've talked about before. Interest rates follow inflation. They do naturally. Organically, they can come down when inflation comes down.
Right.
But here's the fact of the matter: we're at about 3% inflation now, and we were at say 9% inflation in 2022.
Right.
So our average mortgage rate was, let's say, 7% 2 years ago. Inflation's now at 3%. We've been saying mortgage bonds are follow inflation. Here we are, inflation's at 3.5%, and our mortgage bond prices are still at the same levels that they were 2 years ago.
Yeah.
And that's because we don't have the buyer demand. Who are our buyers? And our biggest buyer, the federal government, is not doing it anymore.
So for me, this gets personal because we talk to our clients on the phone, and it's not just a job for us, what we do. We love what we do. We're good at it. Pat us on the back here. We're actually really good at it. And there's a bunch of good lenders out there as well. So we're not the only ones. If you're in Texas, especially Austin area, come by, say hi.
Yeah.
But we want housing more affordable for more people, especially the people when we talk to and we go, what's your monthly budget? And they give us a number that's not even in range. So, like, for a first time, when I bought my house 5.5, 6 years ago, my monthly payment was, I think, $2,200.
Okay.
If I bought that house today, my monthly payment would be
Over yeah.
$3,700.
Yeah.
So that delta is huge
And
for a monthly budget.
And the key there is that wages haven't increased
Not even close.
The same, and no matter what
Right.
industry you're in, if you're a W-2 salaried person out there, your wages haven't necessarily increased 50%. Depends
Right.
on what you do. Of course, there's jobs where you might have moved up and gotten a promotion, but the same job 5 years ago versus the same job today is not necessarily making 50% more.
Yeah. And it's not only that, it's the most important asset you have. And you live in it every day. You sleep in it. You go to the bathroom in it, shower in it, raise your kids in it. And you want the ownership of it because you don't want to be held to a landlord. Plus, you're building equity year over year. And when you sell it, you get a huge wealth return. So it's the best investment to own a home. But the cost is getting so outstretched for a lot of people.
Yeah.
And if we get rates back down, if we get more mortgage-backed securities bought than sold, we'll bring rates down again. If we get the federal government to make the wise decision to enter back into this market instead of being scared of it, because they were in it for a very long time and it did really well, by the way. So proof's in the pudding, and the pudding tasted good a while ago. So let's get back down to that recipe that was delicious. And so I think if we can get that bond to get bought again, especially by the Federal Reserve, if we get loan level pricing adjustments, just stop messing with people and get back down to reality, people. Then we are in a place where in 2 to 3 months we have monster affordability for houses, and people will be able to have that freedom to own their own home again.
Yes, and it will bring back, you touched on investors, it will bring back in some investors who can then have a mortgage payment that will cash flow with rental income, or maybe short-term rental or mid-term rental income. Right. And so many buyers really are on the sidelines, and that's what we're talking about. Now, having said that, it's a tremendous opportunity right now with less competition to find a really amazing home and negotiate with a seller who's really motivated, who may want to sell before the end of the year or whatever. We just talked about that on another episode. So there are tremendous opportunities for buyers right now as it sits, as long as you look at that payment and say, yes, I can do that. That's the worst payment you're pretty much ever going to have. If rates go up from here, you're going to be glad you got the house when you did. Right. Rates go down from here, you're going to be able to refinance when everybody else is jumping into the market, and you're going to have more competition as a buyer. So there's really a tremendous opportunity today, regardless of what happens with interest rates. We just wanted to bring the solution to the table and solve the affordability crisis.
I feel like we did. We should be in charge of everything.
Yes.
The world.
Yes. The world.
What's that song?
I don't want that
If I
job.
ruled the world.
I don't want that job.
Was that Fugees? So thank you so much for listening to the Lending Podcast. Please share this so that we solve world problems for everybody for the housing affordability crisis solved.
Right. We're here in Austin, Texas. We're solving the housing crisis for the entire country.
I love it. Spread word.
Take care.
Thank you.
Talk to y'all soon.
Bye.